What on earth is happening to the stock of Supermicro Computer? The server maker a couple of years ago no one really knew of, because the stock of this company with the ticker SMCI has absolutely skyrocketed in the most recent history. The stock more than tripled since the start of the year. It has risen by more than 700% in the past 12 months, and the stock is up an astonishing 43-fold over the last 5 years, a compounded annual growth rate north of 100%. And with that, Supermicro Computer is even beating the performance of arguably the biggest and most prominent AI winner, Nvidia. So again, what in the world is happening to this company and its underlying stock? In this video, I'll try to provide a very rational explanation that is focused on the 3 key drivers of this spectacular stock performance. And it will also give you an outlook of what's likely to come and how sustainable this performance really is. So without further ado, let's jump right into it. Alright, hi there, my name is René Zellman, and as explained in the introduction of this video, we will take a look at the 3 major driving forces behind the spectacular stock performance of Supermicro Computer. And the first factor is the high AI demand. Nowadays, everywhere you look, everyone is talking about artificial intelligence. Everyone in business communities, everyone in the stock and investing community, and even in educational institutions, everyone is talking about AI. And quite frankly, it's not just a theoretical concept that is nice to think about. No, by now we know that there are a great variety of real-world applications where AI can actually increase productivity or simply make products and services better. And as a result, companies are investing in AI, and they are investing in that space quite heavily. Companies in all sorts of industries. Just to provide a couple of examples of big tech companies that are operating in different spaces. You've got Disney and Netflix who are investing in AI in the entertainment area. You've got Google, who obviously is primarily investing into search and trying to make use of AI to improve its search offering. Then you've got the Microsoft OpenAI chatbots, image generation tools, and so on and so forth. And just as an aside, Microsoft was likely responsible for around, I think, 15% of Nvidia's last quarter revenue. You can already see that the big tech players, they are major drivers of this AI force, so to speak. You've got Meta Platforms with its ad business, trying to use AI to make advertising more accessible to more people, in particular small and medium-sized businesses. You've got Amazon in the e-commerce space, and many other big companies are investing heavily in AI as well. And of course, some companies are major beneficiaries of this high demand for AI. I think by now everyone is familiar with the great performance of Nvidia stock. That, quite frankly, is largely justified. If you look at the growth rates that Nvidia was able to deliver, well, it's just mind-blowing. The company is growing its top line at north of 100%. And I think I released a video on Nvidia quite a while back, and I have to admit that I was wrong. The company has really grown into its excessive valuation. I'm not saying the stock is cheap here right now, but the fundamental performance of the company to a large extent actually justified the great stock performance. And quite frankly, the whole semiconductor industry has been a beneficiary of the AI trend. This chart here, for example, shows that the performance of the semiconductor industry is much better than any other US industry over the shown time period. So all these big companies that I just mentioned, they're all spending big money on AI chips, on AI infrastructure, generally on AI solutions. And SMCI, so Supermicro Computer, is another major beneficiary of the high demand for AI solutions, even though SMCI is not a semiconductor company. So what does Supermicro Computer actually do? And how does this company benefit from this newly emerged trend? Well, Supermicro Computer develops and manufactures high-performance server and storage solutions based on now that's important, a modular and open architecture. And more specifically, Supermicro Computer specializes in the types of high-performance servers that make use of Nvidia's GPUs, basically to power generative AI capabilities in data centers. And put differently, and maybe to explain a little more simplified, as companies continue to invest heavily in AI, they need to expand their server infrastructure to handle the increased user traffic and scale. More specifically, they need AI-optimized servers, and the go-to company that can provide that offering right now is SMCI. In fact, Supermicro Computer's management said that half of its revenue generated in the most recent December quarter was AI related. So again, as a result, SMCI has seen a surge in demand from both new and existing customers, and this is shown in the numbers, which we will get to in just a second. So let's have a look at the growth rates. Well, more recently, in the most recent quarters, SMCI was able to beat Wall Street's forecast, and in fact has delivered the largest beat in its overall history as a public company. And the company also raised its forecast, so it's expecting the growth to continue. It's expected that the revenue of Supermicro Computer will exceed $20 billion in its 2025 fiscal year, which for context is 4 times the revenue the company generated in 2022. And all of this brings me to the second driving force behind the spectacular stock performance of SMCI. So again, the stock is up 43-fold over the last 5 years. And the second force or factor or variable to look at is called operating leverage. So for starters, what is operating leverage? Well, operating leverage refers to the extent in which a company's fixed costs, such as rent, affect the company's profitability. A company with a high degree of fixed costs and somewhat low variable expenses, such as theme park businesses, for example, well, they will have high operating leverage. This means that as the revenue grows, their profits will grow as well, but at an even faster rate. So strictly speaking, operating leverage is a measurement of how each additional dollar in sales is translated into more additional dollars in operating profit. And we can observe this development, this phenomenon, operating leverage at Supermicro Computer as well. Take a look at this chart here. What you can see is that the operating margin of this company was hovering around the 2 to 4% mark for the most part of its most recent history. But ever since 2021, I guess, it has really skyrocketed, is up tremendously, and now just slightly below 10%. And again, to kind of make this more simple to understand, while revenue is up 3x since 2020, the company's operating income is actually up more than 10 times. All right. And let's focus on the third factor I wanted to discuss in this video, and then we discuss how sustainable this development may be. Well, the third factor is multiple expansion. Clearly, there has been a change in sentiment towards the company. And this is reflected in the valuation multiple the company is trading at. Basically, SMCI went from a commodity-like hardware producer, or I should say the valuation of a hardware maker, to a valuation that resembles the valuation of some of its AI peers like Nvidia. Again, let me just show you 2 charts here. So for example, the enterprise value to operating income valuation multiple went from around 5 to above 60 times in a relatively short period of time. And similarly, the price to revenue multiple, price to sales, went from around 0.5, again, much closer to the valuation of the likes of HP and Dell, other commodity-like hardware makers, to around 6 today. So as you can often experience it in the world of stocks, with improved earnings, improved profitability, comes to a higher valuation multiple. Now, the question I want to ask you here is, let me just show you the Gartner hype cycle. Clearly, AI is booming. As I said in the introduction of the video, everyone is talking about AI. But where do you think we are in the hype cycle? Personally, I feel like we are probably close to the peak of the cycle. And if we eventually get to a later phase in the cycle, valuations of companies that are beneficiaries of the AI trend will come down at least a little bit. But if we just get back to the driving forces behind the spectacular stock performance of SMCI, it kind of reminds me of the twin engines concept that investor Chris Meyer coined, that I actually covered in one of my past videos. I'll make sure to link it in the description box down below. What this concept means, twin engines, is that you can get the best stock performance if you combine both an increase in earnings and a significant increase in earnings over time with an expansion of the valuation multiple. So again, the valuation multiple of SMCI alone is up, I think, around 12x over a 3-year time period. And this alone, without any earnings growth, translates into a spectacular compounded annual growth rate of the stock. All right, this brings me to the last chapter of this video, and I think arguably the most interesting one. So please make sure to stick around, because I think what I will talk about in just a second can be transferred to many other companies as well. So how sustainable is this development and stock performance? I have a couple of thoughts here. I think the main question to ask yourself here is, does the most recent stock performance of SMCI already fully reflect the AI boom that we are witnessing? Or maybe even more than that? To answer this question, I want to remind you of some of the key drivers of company value, of intrinsic value. You've got to consider the current cash flow production capabilities. You've got to consider the growth of those free cash flows going forward. You've got to take into account valuation multiples, which we just talked about. You've got to consider the impact of share buybacks. And finally, you also have to take into account the durability of future cash flows. Let me just comment on 2 of these factors here. I'll start with the valuation multiple because this is what we just discussed. Well, what I would say is that just like the so-called twin engines can catapult a stock price higher, stocks can also experience the opposite effect, the so-called double whammy effect of a multiple a company is trading at declining and at the same time earnings going down. Because quite frankly, if earnings go down, the multiple will usually decline as well. And when this happens, this can have just a severe effect on the downside, as the twin engines in the positive sense can make a stock move higher. And if you've been investing for quite a while, you will understand how quickly the narrative around a company, an industry, or the market as a whole can actually change. I think the most recent example that I covered in one of my most recent videos is the change regarding the sentiment towards Google. To me, it felt like when the news regarding the Apple-Google negotiations regarding Google providing AI solutions on Apple devices. I feel like the sentiment went from Google being an AI loser to Google once again becoming an AI winner within a week. And I think the same could happen to SMCI eventually. And then let's discuss a second factor, the durability of cash flow. And to do that, I think we have to assess and look at the business quality of Supermicro Computer. Because while everyone seems to be bullish on the stock, and so the company right now, I think we are actually looking at a fairly low quality company. Because if you just look at the numbers, SMCI is a low gross margin business. And the gross margin, unlike the operating margin, for example, has actually been declining in the most recent history of SMCI. So in the most recent quarter, the gross margin stood at 15.4%, which is extremely low. And it was even as low as 12% in the more recent years. But those margins are rather margins of an automaker. And it kind of, the whole story of SMCI reminds me of the stock of Tesla, which in my opinion is also at best an average company trading at a very high and demanding valuation. That personally, I think the low margin characteristic of those businesses doesn't justify. Because at the end of the day, low gross margins, generally speaking, mean that the company doesn't have pricing power. And obviously low gross margins will then translate into low operating income margins and low free cash flow margins. And so I think SMCI is no way comparable to a company like Nvidia, for example, which as of now at least is showing a lot of pricing power. I can show you on screen, for example, a comparison of the margin structure of Nvidia to the margins that SMCI is posting at the moment. And actually I want to recommend you a Wall Street Journal article that is titled "Supermicro's AI Boom Carries a Big Price Tag." And in it, the authors concluded its booming stock price also seems to be discounting some more difficult realities, though. Of course, for Supermicro, servicing that growth comes at a high cost. The company's business model involves buying up components, such as Nvidia's expensive GPU processors, early in order to quickly design and assemble customized servers for large customers. Yes, and this capital intensity of the business is actually shown in the numbers once again. If we just take a look at the free cash flow production of SMCI in the most recent quarters, we can see that the company burned, if I remember correctly, around 600 million in its most recent quarter alone. And free cash flow has actually been negative in 5 out of the last 10 years of the company being a public company. And I think this capital intensity is also one of the reasons why the company is issuing new shares. It's using public markets to fund its growth ambitions. And in February, Supermicro actually also announced a 1.5 billion debt offering. And if we just consider the share issuance side of things, what matters for the performance of a stock and the total shareholder return at the end of the day is the development of earnings on a per share basis. And obviously, if a company is diluting current shareholders, this is a headwind. If we just take a look at the level of dilution at SMCI over the last few years, we can see that the level of dilution has actually come down a little bit. And I think it is now at a tolerable level. But nonetheless, the company is diluting current shareholders. Now, quite frankly, issuing shares at the current price is probably not a bad thing, and arguably shows that management understands that the current valuation of the company may be a bit elevated. So in a way, they are using their stock right now as a currency to fund future growth. Again, this kind of reminds me of the Tesla model, which objectively I think is not a bad thing here. Now, to get back to the durability of earnings, we also have to consider customer concentration. And I've read that in the most recent quarter, just 2 buyers represented 36% of the company's revenue, which again is something just to be aware of and which I find a little bit worrying. So what's my conclusion here? Well, would I ever invest in this company? Quite frankly, no. And that's first and foremost because the company is not in my circle of competence. I was talking about the stock to a couple of people and I had a really hard time actually grasping their business model. I think I have a somewhat basic understanding of what the company is doing right now. But if you would ask any further, more detailed questions, I think I would struggle. I believe the company is operating in a very cyclical industry and I have no idea where they are in the cycle right now. And I have no idea how cyclical this industry and this business itself will be. And if I cannot answer this with a high degree of certainty, I will be unable to value the company. At the end of the day, it all comes down to growth and the durability of growth going forward. If we just look at the valuation multiples and take into account the qualitative nature of this business and the arguably low quality nature of the business, well, then it seems like the business is at least overvalued if it cannot sustain that growth for a long period of time. Now, let me just remind you of some of the COVID winners, the Zooms, the Etsy's, the payment companies. They all saw excessive growth rates during the pandemic years. However, many of these growth rates have come down significantly, and many of these companies posted negative year-over-year growth rates eventually. And I'm not sure if the same would not be true for SMCI once the AI hype slows down a little bit. And you also have to take into account competition. Competitors like Dell, for example, they are really also seeing a rise in demand. And Jensen Huang, the CEO of Nvidia, actually said, quote unquote, "Nobody is better at building end-to-end systems of very large scale for enterprise than Dell." And if we look at the stock chart of Dell and the performance of the company in the most recent quarter, we can already see that they are also starting to build momentum here. So as you can see, there's a lot to take into account. I think I'll call it a day here and I'll close it with the words of my friend Andrew, who wrote me on WhatsApp: "I'd rather be very and be proven wrong than be hopeful and be proven wrong." That's it. See you in one of my next videos. Take care.